Let me do some positing. I think international can double. I think men's can double. I think accessories can double. Those, to me, explain that you are not late in the game, but early in the game.
We agree. Actually, our power of 3 times 2 is to quadruple our international business. And I've shared before that as we look forward, our international North American business can be 50% of the revenue of the company. Today, it represents 17%. We're having success in every market we're in. In Europe, we opened 2 stores in Spain, incredibly successful. Our Asia Pacific markets are all contributing, driving growth. There isn't a market we're in that isn't double-digit growth around the globe, and being driven through product, being driven through our community efforts, which connect us to our guests and our unique D2C model.
I want to be sure people understand. You point blank say here, mainland China playing a big part of that performance. You're not one of those people who's either abandoning China or being concerned about near-term issues, as I imagine.
No, we saw 70% growth on a 3-year CAGR last quarter, and that is with stores and the teams being challenged with COVID outbreaks. So we're very confident in our business. We have great brand momentum in market and excited. We continue to invest, opening incredible stores and seeing success across both Tier 1, Tier 2 cities, and both physical and our .com channels. So it's exciting to see the momentum of the brand in the market, and it is a big part of us quadrupling our international over the next 5 years.
Mr. McDonald, it's David Faber. In the near term, particularly in this holiday season, I'm just curious to get your senses to the consumer. Are they as strong as they have been? Are you a bit concerned, perhaps, that there is starting to, be some weakness that's being shown?
Morning, David. We haven't seen any weakness with our consumer. We're well aware of the macro environment. We're well aware that many other retailers in the malls are heavily discounting. We have not. We don't see a need to. Regular price is driving our business. And as we look forward, what I would just call out versus last year, where we saw a lot of gift giving pulled forward into the quarter, it really started to just tick up over the Thanksgiving weekend. So that would suggest there's a lot of gift giving still to come, and that's what we're tracking and looking for. But on a quarter-to-date basis, our guest metrics remain very healthy, and I shared the Q3 ones, and there's no change in that behavior. But it is the gift giving in this quarter that's critical, and behavior is pushing it. It appears to be closer to the holiday than last year when the headlines were shop early.
Calvin, some on the street point out that Lulu has a history of guiding pretty conservatively in December and then raising in January. Any reason to think that pattern might be broken?
We're pleased where we're at from a quarter to date perspective, and feel the guidance of 23 to 24% under the circumstances of some of the topics we discussed is the appropriate and right guidance at this point. And the teams are ready and focused, and we have the product. And what we've seen through the Thanksgiving weekend is the product continues to resonate. We're acquiring new guests as well as our existing guests engaging with us. So we're excited about the holiday season, but there's some critical weeks still ahead for us.
Yeah, and I know Jim asked you a bit about this, but, some of the analysts being concerned about what they called higher inventory than they might have expected, and your CFO obviously defending that. Can you give our viewers a sense as to why they should not be concerned about, obviously, what was a growing inventory level at the company at this point?
No, for sure. Inventory came into where we guided, and we did say Q3 would be the high point of our inventory numbers. It's a combination of where our manufacturer partners were and their ability to fulfill our orders, a combination of managing ocean and air and trying to get ahead of that balance and costs on shipping. And on a 3-year CAGR, it's up 38% on a unit basis on a growth of 27%. So we're definitely sitting we are sitting above our growth number, but with almost half of that inventory being core non-seasonal inventory, Those investments, we believe, have helped fuel our demand. We're selling at full price, and we're well positioned for the holiday heading into Q1, and we will start to now be able to work those inventory numbers down. But we don't see and haven't called out any concern or risk